My name is Farhan. Today you will solve question number 5 from 2017 past exam. In this question, you will prepare the balance day adjustments at the end of the reporting period. We also have two discussion questions, which we are going to look into at the end of the lesson. So let's start with the question now. CLU Lipsticks is a small business that sells quality lipsticks. Reports are prepared annually on 30 June. The accountant has provided the following extract from a pre-adjusted trial balance as of 30 June 2017. So here you can see we are given the various items which are either within the debit column or the credit column, and then you are given some additional information at the end of the reporting period. The first requirement is to explain the purpose of preparing a pre-adjusted trial balance, and the second requirement is to record the additional information in the general journal, which is basically this outline that has been given to us. You can either record within the general ledger and the subsidiary ledger. So let's start with the first additional information that we are given for this question. The vehicle is depreciated at a rate of 25% per annum using the reducing balance method. The vehicle has a useful life of 4 years and an expected residual value of $4,000. Now, given that we know that we are using the reducing balance method, if you want to calculate depreciation using this method, we can do that by using the percentage, the relevant depreciation rate that we are given in the question, and multiplying it with the carrying amount. Now, the reason we want to find the carrying amount is because we're using the reducing balance method. So when you're using the reducing balance method and you want to find the depreciation of the asset in year 2 or year 3 of its usage, then you have to apply the percentage, which is 25 given in our case, multiplied with the carrying amount. So how do we find the carrying amount? Now, the carrying amount at any given point in time can be calculated by taking the original cost and then subtracting the total depreciation, which is also known as the accumulated depreciation. Now, where do I get the original cost from? Now, the cost of the asset, which is the vehicle, based on this question, is what is going to be recorded within the debit column of the pre-adjusted trial balance. Now, if you check the debit column of the pre-adjusted trial balance, you can see the vehicle is here at the end, and it's reported in the debit column as $44,134. So this is the cost value of this asset. What about the total depreciation? The total depreciation is given at the very beginning, which is accumulated depreciation of vehicle reported within the credit column of 5,634. So to find the carrying amount, we subtract the total depreciation from the cost and we end up getting $38,500. So this $38,500 is what we're going to multiply with the given depreciation annual rate of 25%, and we get $9,625 as the depreciation expense on an annual basis. Now, given that the business reports on an annual basis, and given that we didn't purchase any vehicles, nor did we dispose any vehicle during the year, this number needs no further adjustments. Now, how do we record this in the general journal? Now, if you were to journalize this simply, then you debit the depreciation of vehicle by 9,625, which is increasing the expenses that we are going to report in the income statement. And then we credit the accumulated depreciation of vehicle by 9,625, which is a contra asset account that is created to show the reduction or the economic benefits that we have consumed from the relevant asset, which in this case is the vehicle. Now, if you check the outline that's been given to us in the exam, the working space, so we are given the two options of either recording this within the general ledger or the subsidiary ledger columns. So let's understand the difference between the general ledger and the subsidiary ledger. Now, the general ledger records anything relevant to assets, equity, liabilities, income, and expenses, while the subsidiary ledger has detailed individual customer and supplier accounts. Now, let me explain you this further. So this means that the accounts receivable, which is going to be reported within the general ledger as the total amount that we have done in terms of transactions with our credit customers. If you were to look into the subsidiary ledger, then you will find separate accounts for each credit customer involved, which is customer A, customer B, and customer C. So the subsidiary ledger has the individual accounts, the individual track record with each of these customers. But if you were to add all the transactions that we have done together with all these customers, then the total amount will be reported as a summary within the accounts receivable ledger account in the general ledger. Now, the same thing is applicable for the accounts payable. In the general ledger, we show the total transactions, the summary of all the transactions that we have done with all the credit suppliers of the business. If you were to look into the subsidiary ledger, then you will find separate supplier accounts. And let's say in this case, we have 3 credit suppliers. So in the subsidiary ledger, you're going to have 3 separate accounts for 3 credit suppliers. And the total of all the transactions we have done with all these 3 credit suppliers will be reported as a summary within the accounts payable ledger account that is prepared within the general ledger. All right. So given that we're recording an expense, which is to debit depreciation of vehicle, so it has no relevance to any accounts receivable or accounts payable. And therefore, it's very clear that we will record this within the general ledger columns. So you can see 30 June 2017, which is the end of the reporting period. I'm debiting depreciation of vehicles by 9,625. You have to be very specific. You cannot write depreciation expense because you will lose marks, because you need to be specific with the asset that we're talking about. And then you credit accumulated depreciation of vehicle by 9,625, which is a contra asset account. All right, so let's move to the next additional information that we have. So interest on the bank term deposit is 6% per annum and is received annually. The term deposit was established on 1 October 2016. Now, the bank term deposit that we are talking about here is reported within the debit column. And this bank term deposit refers to an investment that the business has made. In other words, this is an asset for the business. Now, because the business has made an investment, which is basically deposit some money into the bank account, and in return, the business is going to get some interest as income or revenue. So how do we calculate this interest, given the interest rate is 6% per annum? Now, if you were to calculate the interest revenue on an annual basis, then you would multiply the given rate of 6% with the $12,000, the investment that we have made. And on that basis, we get $720 as the interest revenue every year. Now, we also know the question explicitly mentions that the term deposit was established on 1 October 2016. Given that we're preparing the balance sheet adjustments at 30 June 2017, from 1 October 2016 until 30 June 2017, we have 9 months so far for this term deposit that is in place. So how do we know it's 9 months? So it's October, November, December, January, February, that's 5 months, March, April, May, June. So that's 5 and 4, 9 months in total. Okay, so how do we find the monthly interest? So if we know the interest revenue per annum is 720, then the monthly interest revenue can be easily calculated by dividing the annual 720 with 12, and we get $60. Now, how much is it for 9 months then? So for 9 months, the total is going to be $60 multiplied by 9, which is $540. All right, so how do we record this within the journal space that we're given? All right, so you can see that we are debiting accrued interest revenue within the general ledger on the debit side, which is also known as the interest receivable. This is because the interest revenue is an income, and we as a business have made this investment in the bank, and we expect to get some interest in the future. So this interest is fitting the definition of a current asset, and all assets are debit when they increase. So that's why we are debiting accrued interest revenue, which is also known as interest receivable, by $540 on the debit side. Then we are recording the income, which is the credit interest revenue, by $540. Now, we are doing this within the general ledger columns because we do not have any accounts receivable or any accounts payable involved within this transaction. So there is no question of thinking about subsidiary ledger at all in this case. It is just recording a current asset and an income straightforward within the general ledger, which is to debit the accrued interest revenue and credit the interest revenue. So let's move to the third transaction that we have. Rent is paid in advance and is paid twice a year on 1 February and 1 August. Rent is $300 per month plus GST. Okay, so if we are given the rent on a monthly basis, which is $300, and given that we know for sure that the business prepares reports on an annual basis, how much is the total rent expense in a year? So the total rent expense in a year is simply $300 on a monthly basis multiplied by 12 months, which gives us $3,600. Now, you can just solve this transaction straight away, which is to calculate the rent expense for the entire year and then do the journal entries afterwards. But we are going to go a bit more in depth and learn all the information that we are given in this question. So the rent is $300 per month plus GST. Now, the GST that we are paying on rent is not a part of the total expense that we are going to report within the income statement. It is rather going to the GST clearing account, which by default is a liability account. So any GST that we're paying on rent is basically going to the GST clearing account to offset the obligation that we have towards the ATO in terms of GST that we collect from our customers. Because how does GST settlement work? So we collect GST from sales that we have made to our customers, and then we pay GST on any expenses or purchases of inventory. This GST that we pay can be used as an offset to calculate the final balance that we owe the ATO, which is usually taken care of at the end of the reporting period. So what about the journal entry? If you check the pre-adjusted trial balance, you're given the prepaid rent expense, which is $3,900 reported within the debit column. Because this is prepaid rent expense, this is a current asset account to begin with. So now that we have expensed 12 months of rent during this financial year ending 30 June 2017, then we have to reduce this prepaid expense of $3,900 that is reported within the pre-adjusted trial balance. The way we do this is to credit the pre-adjusted trial balance. So when we are crediting the pre-adjusted trial balance, we are crediting the prepaid rent expense by 360. So when we are crediting the prepaid rent expense by 360, we are reducing the economic benefits that comes with the prepaid rent expense originally reported in the pre-adjusted trial balance, because we have consumed these economic benefits because we have used the space for 12 months and a portion of that has already been consumed and expensed. So therefore, we are debiting rent expense by $3,600 and we are crediting prepaid rent expense by $3,600. So when we debit rent expense by $3,600, then your profit should go down within the income statement. But when we are crediting prepaid rent expense by $3,600, then the reported current asset in the statement of financial position or the balance sheet should also decrease. All right. So I also want to calculate more things here. Now, after the rent expense has been adjusted for, what's the balance of the prepaid rent expense at 30 June 2017? It's $3,900, which is originally given in the pre-adjusted trial balance, minus $3,600 in the expense that we have already consumed, which leaves us with $300 or 1 month of prepaid rent. All right, at 30 June 2017, which is the current asset balance that remains in the books. Now, let's verify this further. Now, we know that rent is paid twice a year, and when we pay the rent, we pay for 6 months in advance. So we know that the rent is paid on 1st August and 1st February. This means the rent would have been paid on 1st August 2016, which would have covered the entire month of August, September, October, November, December, and January, all the 6 months. Then we also pay rent on 1st of February 2017, which would cover the months February, March, April, May, June, and July. So these are the 6 months in 2017. But we are preparing the balance day adjustments at 30 June 2017. So 1 month of rent is left behind here, which is the prepaid rent that we are yet to consume. And if you were preparing the balance sheet, you would report this prepaid rent within the current asset section that represents the economic benefits that are yet to be consumed by the business. All right. So how do we generalize this within the given outline or the working space? Again, we do not really have any accounts receivable or any accounts payable involved within this transaction. So you can just simply report this expense and the reduction in the current asset within the general ledger columns. So for the year ended 30 June 2017, I'm debiting rent expense by $3,600, reflecting an increase in expenses, and then crediting prepaid rent expense by $3,600, which shows that the economic benefits have been consumed and we have to reduce them by crediting the asset account. Okay, so let's move to point number 4. CLU Lipsticks was advised that debtor Chilo Cosmetics is bankrupt, and CLU Lipsticks will receive only 20 cents in the dollar of the $890 owed. The cash is expected to receive in August 2017. Right, so we have this credit customer known as Chilo Cosmetics, and we just got to know that they won't be able to make payment for a large amount that we have done business with them. So they're saying that they can only pay 20 cents in the dollar of the $890 owed, which means 80 cents on the dollar is a bad debt. So how do we find this bad debt? Now, 20 cents here simply refers to 20%. 20 cents in the dollar simply refers to 20% of the sales amount that we have with them. And 80% that is going to be bad debt simply refers to 0.80 times 890. All right, so if you want to find the bad debts, which is the 80% that we know that we are not collecting because our customer went bankrupt, and given the original sales amount is $890, so we multiply 80% with $890, and the bad debts is $712, which means if you do 890 minus 712, you should get $178, which refers to the 20% that our credit customer has confirmed that they will be able to pay, but this is going to happen in August 2017, and this is not our concern at this very moment. Now, if you were to adjust this at the end of the reporting period on 30 June 2017, how do we do this? So anytime you have a bad debt, it means that you have an expense, and when expenses go up, you debit them. So therefore, at 30 June 2017, you're debiting bad debts expense by 712. Now, this bad debts expense relates to one customer, Chilo Cosmetics, the total of which would be reported within the accounts receivable in the general ledger. But given that now we have a bad debt, we need to reflect this reduction within the accounts receivable ledger account in the general ledger. Right? So when we reduce this within the accounts receivable account, which by default is an asset account, now that we're reducing this because of the bad debt, we have to credit it, right? So therefore, bad debts expense is debit by 712 and accounts receivable is credit by 712 within the general ledger. Now, we know for sure that we have one customer involved here. So what about the individual account of Chilo Cosmetics that we have in the subsidiary ledger? So the individual account of Chilo Cosmetics that we have in the subsidiary ledger also needs to show this reduction due to the bad debts that they have confirmed, and that we have derived by multiplying 80% with the original sales amount of $890 that we have with this customer. Okay, so in the subsidiary ledger, you're going to credit accounts receivable for Chilo. So you have to be very specific here because the subsidiary ledger has individual accounts for all customers and all suppliers with whom we do business on credit. So essentially, you are doing 3 journals here, so 3 lines, and that's how you'll get full marks. So we debit bad debts expense by 712 in the general ledger. We credit just accounts receivable by 712 in the general ledger, and then we credit accounts receivable, specifically the account for Chilo that we are preparing in the subsidiary ledger. All right, so that you can see here 712 is credited. Okay, so let's move to additional information number 5. Yes, a payment for wages of $280 was incorrectly recorded as a payment for drawings. All right, so we paid salaries and wages to our staff, but we incorrectly recorded this as drawings. So when we record drawings, what do? We debit drawings, right? But because there were no drawings to begin with, we need to remove drawings that we have recorded earlier. So if you want to remove drawings, you have to credit drawings by 280. And then you're correctly recording wages of 280. So when you record wages in the books, you have to debit it because wages are an expense of the business, and all expenses, when they're incurred, they're debited. So we debit wages by $280 and we credit drawings by $280. When we are debiting wages by $280, we're increasing the expenses of the business. And when we are crediting drawings by $280, we are reducing drawings, reflecting that this has been incorrectly recorded earlier. Right? So again, we do not have any accounts receivable or any accounts payable involved here to begin with. So therefore, we can simply record this within the general ledger columns, which is to just record the wages debit by 260 and drawings credit by 260 at 30 June 2017. So let's move to additional information number 6, excuse me. The owner donated $160 of stock to the local kindergarten for its annual fundraiser. The owner had not recognized this entry when conducting the stock take. Right. So although the owner has donated some of the inventory, this donation is for the purpose of advertising. You need to see things logically. This donation is not just a gift. It is a gift, but obviously people will know that this business has donated such stuff. So there is this purpose of advertising, because whatever inventory the owner was able to donate, the owner is able to write that off for tax purposes and reduce taxes when the tax obligation comes with the ATO. So we need to treat this as an advertising, this donation that has been made by the business to the local kindergarten. All right. So given that we know that this is an advertising, so we debit the advertising expense by $160 because advertising is an expense, and because we have made the donations, this reflects an advertising. And then we are crediting inventory by 160 because the items we have specifically donated are the inventories that we originally sell to our customers. So when we are crediting inventory by 160, we are reflecting a reduction in the current assets that we have in the books for inventory. And when we are debiting advertising expense by 160, we're increasing the expenses that we have in the books, which in turn will reduce your profit. And where do we record this? I believe you guessed that correctly, of course, within the general ledger. So at 30 June 2017, we debit advertising expense by 160 and we credit inventory by 160. All right. So what about the last additional information that we have? Okay, so I didn't mention one thing here. So this question is from the old curriculum, right? So debtors control is what we now refer to as accounts receivable, and stock control are what we now refer to as inventory. And then you have creditors control, whom we now refer to as accounts payable. All right, so don't be confused with the terminologies. So the last additional information says that the stock take showed $21,860 of stock on hand. All right. And if you recall point number 6, that clearly mentioned that the owner forgot to record the fact that $160 of inventory was donated as well. All right. Okay. So based on our calculations, if you were to calculate and find the right amount based on the information that we know prior to the stock take is basically counting each and every item of inventory by hand. So prior to that happening, if you were to just use the numbers that we have and find the amount of inventory that we expect to have, then that can be calculated by taking $22,400, which is the inventory amount reported in the pre-adjusted trial balance that hasn't been adjusted before. And then we are subtracting the $160, which we have donated to the kindergarten, right? So based on that, we are left with $22,240 as the inventory that we should have in the books. And this is only based on our calculations. But the stock takes say that we actually have $21,860. So if you are manually counting by hand, that is more accurate figure. we expect, right? So based on our calculations, if we have 22,240 and based on the stock take, we know that we have $21,860. This means now we have to reduce the inventory that we have reported within the books, right? And the difference, the amount that we're going to reduce is simply $360. So how do we reduce this as a journal entry? So we debit inventory loss because all losses are treated as expenses, contrary to how all profits are treated as income. So all expenses are debited, all profits, all revenue, all income are credited. So we debit inventory loss by $360. The reason this is a loss is because based on our calculations, we thought we would have 22,240, but the count by hand revealed that it's actually 21,860, which found a difference of 360 that we need to remove from the books, and we are treating this as an inventory loss, which is an expense for the business. So any expenses are debited, so that's why we are debiting inventory loss by 360. At the same time, this loss comes from the inventory that we have reported in the business as a current asset, right? So therefore, when current assets are being reduced, we have to credit them because all assets, when they go up, we debit them, and when they go down, we credit them. So we are debiting inventory loss by $360 and we are crediting inventory by $360. And this is again done within the general ledger column because we're simply reporting an expense and an asset, and we have nothing to do with either accounts receivable or accounts payable. All right, so that takes care of all the additional information that we have. So let's look into the discussion questions that we have. All right, so the first one is asking to explain the purpose of preparing a pre-adjusted trial balance. The main purpose of preparing a pre-adjusted trial balance is to check whether the total debits that we have got from the general ledger equal the total credits that we have also got from the general ledger. If the total debits and the total credits are not equal to each other, then we know something is wrong and we go look for that error and then we fix it, right? We need to fix this because if we do not fix this, then whatever financial statements we're going to prepare afterwards, which are the income statement and the statement of financial position, also known as the balance sheet, will be inaccurate. All right, so we want to prevent that, and that is why we're preparing a pre-adjusted trial balance to ensure that whatever we have recorded since the beginning, the entire double entry process has been done correctly. And if not, we fix any errors we find, and then we prepare the financial statements. Okay, so what about question C? It can be argued that the inclusion of depreciation in the income statement breaches a qualitative characteristic. It can also be argued that the inclusion of depreciation in the income statement is supported by another qualitative characteristic and an accounting principle. Discuss. So if you want to calculate depreciation, you know we have estimations involved here. We have estimations in terms of the residual value, which is the likely market value after the end of the useful life of the asset that we will be able to sell this asset for. And we also have the percentage, and then we have the useful life. So all these are estimations, and these estimations may not necessarily be accurate, all right? So that's when the question about whether these estimations that are used in the calculation of the derivation of this depreciation expense, which is reported in the income statement, is actually in fact relevant. So the accounting qualitative characteristic that we're talking about here is the concept of relevance. Okay? Sorry, not relevance, the concept of reliability, because we are talking about estimations, right? So the concept of reliability. Because we cannot identify the depreciation with 100% certainty, it's basically based on judgments, which we hope to ensure that they are reasonable, and therefore whatever profits and losses that we make during disposal have been done with as much certainty as possible. So here, the question about reliability as a qualitative characteristic arises. Okay, so this is the reason why the inclusion of depreciation in the income statement may breach a qualitative characteristic as an argument. Okay? All right. Now, let's look into the second qualitative characteristic which supports the inclusion of depreciation, and that is relevance. Because depreciation expense refers to the loss of the non-current asset, and this loss in the value of the non-current asset, and this loss in the value of a non-current asset is basically the economic benefits that we have consumed as a business for the purpose of generating revenue. We buy non-current assets as a business so that these non-current assets help us generate revenue. So we use the economic benefits, we consume the economic benefits that comes from these non-current assets that we purchase. And therefore, here the concept of relevance makes sense. So if we were to look into any accounting principle, we could look into two of them. We could look into the reporting principle, which ensures that all the expenses for the period incurred are actually matched against the revenues that we have earned for the purpose of determining accurate profit. We could also talk about the accrual basis concept, which basically says the same thing, that all revenues that have been earned and all expenses that have been incurred must be used for the purpose of calculating an accurate profit figure. So on that basis, using the qualitative characteristics of relevance and the accounting principles of matching and accrual basis, it makes sense, because if we were to leave the depreciation expense out, then we would be understating expenses, which will be overstating the profit, and this may have a significant impact in decision making. Because remember, we are purchasing assets only for the purpose of utilizing those assets within the business and therefore help us generate more revenue. So because this is a 6-mark question, so exactly all the points that I've discussed, if you were to mention them properly, one line after one line, I truly believe you're going to get full marks. All right? So that's all for this question. Now, I know exams are coming soon in November, and if you are worried, there's nothing to worry about. If you need help, make sure to check the links in the description. I'm offering tutoring sessions, and you can discuss your requirements with me. This is a free call. You can book a call and discuss your requirements with me, and I'll definitely work out a plan with you. So that's all for today's lesson. So make sure to like this video and subscribe to this channel. And any other topics you need me to cover, any other specific questions from past exam papers, make sure to post them down in the comments below. And I'll see you in the next video.